right, we're going to start back on page 38, because remember I told you we're going to go into inventory tonight.
Might be able to zoom it in a little bit, but...
Because it's a lot easier to discuss inventory when I have some data in the file. Hold on a second. All right, so has everybody turned to that page? Sorry. 38, isn't it? When we talk about anytime you want to invoice in QuickBooks, I know it's strange to say, notice it's called items. We have a tendency to call it inventory, but it's really items because it's not just merchandise that you stock and store on the shelf. Anytime you want to do an invoice in QuickBooks, you have to have an item. Even if you're selling services, even if you were doing rent. You know, anybody in here have rental units and you want to bill your customers for rent? You would create a service item called rent. So when you look on page 38, it talks about the different item types. I know, I call it inventory too, it's not good, it's called items. So when I go to list, and I say item list, that's where you find your items. You look at the type, service, inventory part, non-inventory part, other charge. The only item type that will track quantities and the cost is called an inventory part. That's the only one. So you see it there, says, well, you know, there's such a thing as assemblies, but I don't think they have that in QuickBooks Pro anymore. So inventory part. That means when you buy this water and you're going to resell it, it knows how many you bought, the price you paid. It stores the cost, the price you paid, as an asset on your balance sheet under inventory. Then when you sell it, it removes the items you're selling and expenses the cost and also books the revenue. Okay? Everybody understand what I just said? That's the only item type that will do that. It's only used by people who are what I call merchandisers. You're selling, you're buying stuff to resell. For the rest of us, like me, I'm a service-based business or someone who's a landlord. Or let's say you're a landscaper and you're going to go landscape at this client's and you're going to buy some arborvitaes and some hydrangeas. Well, you would do that as a non-inventory part because you're not buying that and storing it to sell it later. You're buying it for that particular job, but you want to be able to invoice it to your client. So anytime you're going to create invoices in QuickBooks, you have to pick one of these item types and create it. For most of you, it'll probably be service. Notice that the other thing you have under your item list is where you create your sales tax items. So, of course, in this state, we have a sales tax item, Cuyahoga, Summit, Medina, everybody's different rate. And then any other charges, so let's say you have delivery fees or expediting fees, that would be under other charge. All right? So when we want to add items to the list, well, first let's take a look at each one of these. I'm going to look at some of the service first. Notice the fields on a service item type. This is the name that's going to appear on the customer invoice. It'll be called gardening. The rate, notice it calls it a rate. They left it blank because maybe they charge a different hourly rate or unit rate depending on what they're doing. So you could enter that when you're doing the invoice. So you can just enter what the rate is, and then it will multiply it across. They're saying that this service is non-taxable. This is a non-taxable service. All right? So you will have items that may be non-taxable, and then items that are taxable. So you set that on the item type. And then they're going to book whatever revenue they get from this under landscaping services installation. That's their income account. Notice this data file doesn't use numbers on the chart of accounts. So that is a revenue account, because notice it says income. So they want to track all their sales for this particular service under this general ledger account. So that's a service. Let's take a look at an inventory part. Notice all the additional fields that are in here for an inventory part. Again, this is the name that's going to appear on the invoice to the customer. Cost, that auto-fills as you buy these items. All right, it'll change it. Every time you buy it, it'll change the cost, the last cost you paid. But when it removes the cost for the items you sold, QuickBooks uses what's called average cost. Any of you ever hear of LIFO, FIFO, average cost? QuickBooks can only do average cost. So when you relieve the item from inventory by selling it, the expense is going to be booked at the average cost. So if you've bought this over time, it won't be what you paid for it last. It'll be the average. It's going to book the expense for the sale. You know, what did I pay for this thing of water? To cost of goods sold. The revenue they're putting into landscaping services, job materials, miscellaneous materials. Yes? No, you can't correct it. It does it. It's internally doing it. So when you're going to see here in a minute, when we put a vendor invoice in for buying quantities, it'll put in here the last price you paid on the invoice. But if you have items already in there and you may have paid a lower price, it will average. It maintains an average of what you paid for these items. And that's what it expenses. All right, so again, we have a place to book the expense and a place to book the landscape, the sales. It also tells us right now we have nothing on hand. The reorder point, hysterical, this is not my data file, is -1. What the reorder point does is it tells you as a trigger, you can run a report that says, tell me the items I'm low on stock and need to reorder, and you set that. So you know your lead time, how much do you sell these things usually, and how much more, there's a seat right up here. And how much more do you need to, you know, how many days, how many will you need to have on hand before you can reorder more? Because you'll know how long it takes to get it. See that average cost? You can't change that. Yes?
So if I'm selling drinks overall, and I paid $10 for water, $15 for juice, whatever for coffee, do you find it better to break it down instead of the overall drinks, to break it down to water, coffee, juice?
I would do it that way.
So it's a more detailed.
Because you're going to sell it differently too. Because you're going to have a markup on your cost. You know, if I'm paying $10 for this, I might sell for $15. If I'm paying $5 for it, I might sell for $10. It's the item, you know, so you'd have all your similar categories of items as an item, an inventory part, each separate inventory part.
Do I know when we buy our items, what I might get it from one wholesaler from the next might be different, and it might be...
No, they would still be under this item. I'm saying, when you're saying you're buying Coke, you're buying root beer, you know, I would have those as different items, but it doesn't matter who you're buying it from. That's the item. It's what you're selling, the Coke, the root beer.
If I buy it for $1 today and then $1.25 tomorrow, then it makes it...
It'll average it.
25, average out.
Yeah, it averages it. Right? Any questions on what is an inventory part? Yes?
If you are a stick manufacturing, so you have raw materials and then you have finished product, you can involve parts. How do you
You don't. This system is not designed for that. Now, I have a client who makes custom auto parts, all right? He's a small business. So he wants to spend his life, getting this because they have a manufacturer's add-on to this. And I'm like, dude, you can't even keep your accounting records. Why are you so caught up into the minutia to figure out? Do you see what I'm saying? Don't get burdened down. As you get bigger, you add on and get more improved systems for manufacturing. But you could track your raw materials here, and as you use them in something, it'll relieve the cost, but you're not really selling it for anything. It's just this is not designed to do that. It's not that sophisticated. To do that, you have to get a higher version. All right? Any questions? All right, so now let's look at a non-inventory part. This is where I was talking about if you're selling the arborvitae, you're going out, you're buying it for the specific for the customer job. It's not something you're buying and setting on a shelf to resell. Again, you're going to have, this is going to be the item. Look, this is concrete. And I buy it from a vendor. Now, if you say this item is purchased for a specific customer job, you're doing job costing, you can click that. Again, the sales are going to go here. So where's the cost going? You always want to think about, I'm selling this, but I also bought it. When it's a non-inventory part, you record the expense when you pay the bill to wherever you bought it. As opposed to an inventory part, when you pay the bill for wherever you bought it, it sits as an asset till you sell it. Because it is something that's sitting on a shelf until you sell it. You understand the difference? This is not sitting on a shelf till I sell it. I bought it just for this thing. I go buy it, I go install it, whatever it is I'm doing. But I want it to appear on the customer's invoice so that I can show them, here's your part, here's my service. The other thing too is depending on what it is, it may be sales taxable if it's a part and not sales taxable when it's the service. You have to look at what it is you're doing. So you want to have those things different. All right? Yes?
What about your consumables? Zip ties, nuts, bolts?
Expensive. Absolutely expensive. You're not big enough to... when I buy them, I just expense it as supplies. Supplies expense. You don't want to get to the point where you're so... I always loved an accounting class. They said, go do an inventory on your supplies, like pencils and paper. Are you kidding me? Nobody does that stuff. Why are you teaching people the most ridiculous thing in the world? I used to teach at the University of Akron, in case you didn't know. I'm like, look, I'm going to tell you that this book says to go do an inventory on supplies, but in the real world, we don't do this stuff. Because it's not cost effective. So zip ties and all that kind of stuff, it's not cost effective. Is anybody in here a manufacturer? What do you guys manufacture? So what do you? Okay. What do you do?
Health beverage.
Okay. Because there's such a thing, and again, I have to put a caveat here that I'm not giving you legal advice. As a lawyer, I have to say that thing, but there is a manufacturer's exemption that you have under the sales tax code. So anything you buy, any equipment you buy and use in the manufacturing process is exempt from sales tax. All right? It has to be directly used in the manufacturing process. Screwdrivers, anything, cleaning products used in the manufacturing process. So you would do a sales tax exemption certificate under the manufacturing exclusion. All right, so now let's look at, I think we covered, other charge. Again, this could be FedEx fee, delivery charge, whatever it is. It's just an add-on. It's just so you show things on the customer, whatever you want to show on the customer invoice, make sure it's over here as an item. You can't just free flow type in there. You have to select something and put it in there. All right, any questions? Yes?
I'm using the online version, and I can type on my invoices all the time.
Wow, the online version lets you do that?
Yeah, I don't use items. I make custom dates, so I don't have any inventory and anything, so I just put in the invoice the description.
How does it know where to book the revenue?
What's that?
How does it know where to book the revenue? This gives it the general ledger account.
I am not an accounting person.
So you have to have at least one item type. Maybe you just call it all cake or something. And then you can freely type in the description because it has to be directed to where to book. It has to know where to book the revenue in what general ledger account. That'd be interesting.
Good news is I have a meeting set up with my accountant.
Okay. I'm going to go look at one of my clients' online things. You know, if all you're doing is one thing, see, I would have just one service and it all goes in one revenue account, but I don't know how it knows behind the keys where to post it. That's what this is telling it, behind the keys, where am I posting revenue, where am I posting costs. All right, so let's look at a sales tax, because we haven't done that yet. This one has a group, you don't really need that, so earthquake assessment, that's good. So for us, we would have things like you would have Medina County, Summit, whatever county you're in. If you're only in one, you only need one sales tax item. But if you're going and providing services in different counties, you have to charge the sales tax or the county where you're delivering the service, okay? And then what you do is you generally have a vendor that's created. You have to create a vendor account so it knows where to pay it, like the Ohio Department of Tax. And then you put your rate in. Yes. You got to go change it. You won't backward change it. You'll just forward change it. That's a good question. And that's why, remember, you pay sales tax when you invoice. And that's one of the reasons for that, is that, you know, a rate may change in the middle of the year or the following year. And so by the time you collect it from the customer, it would be at a different rate. So you're doing accrual basis on sales tax. Whenever it's invoiced, that's when it's owed. But then when you go in and change the rate, it doesn't go back and change existing invoices. It only takes it forward. All right? Yes?
If I go to, let's say, and I buy purchase and I turn around and sell those goods to a client, can I charge them sales tax, or is that
No, you have to charge them sales tax, but the thing is you shouldn't be paying it at Staples. That's where you get the resale certificate. You should not be paying it when you buy it, when you're turning around and selling it. It is. It is double taxation. Yes.
And then is labor fees, are these all taxable as well, or is it just?
It depends on what you're doing. All right? So if you go in and make a repair to, I don't know, somebody's toilet, yeah. But if you go in and you install something that's affixed to the building, then no. All right, so that's why you have to look at the sales tax exclusions. If I go in and give you if I go in and give you consulting services for computers, I don't charge a sales tax. But if I custom design a piece of software for you, I have to charge sales tax on all of it. All right? Let's look now at using these items. Or let's look at, if you add an item, all you're going to do is, like below, item, new, and you go in and pick what it is. Now let me tell you, once you pick this and you set it up, you can't go back and change it. All right? I had a client who set up everything as an inventory part and really was a service. And I'm like, sorry, buddy, but you can't change it. You got to go recreate it. That's a big pain. All right, so you want to make sure you get this right at the beginning. Yes? Yes. But it still has to know where to post it, so I'd be interested to see that. All right? Yeah.
Did you say you can only inventory finished goods or raw materials as well?
You could do raw materials, but you're not really invoicing the raw material. This is not set up to, in a true manufacturing environment, you take your raw materials and you create these things. It used to be in QuickBooks, assemblies, and it takes this many pieces of this and that many pieces of that, and then it creates the item that you sell. QuickBooks Pro is not going to do that for you. But if you are somebody who says, I need to keep a handle on the raw materials that I have on hand, then you're going to want to, keep them in here, realizing you're not invoicing on the raw material. You are invoicing on the finished good.
But for tax purposes, your raw materials, where does that show up as inventory at the end of the year?
You would have to manually know that.
Oh, okay.
Yeah. Yeah, this is not really designed to be in manufacturing. You can buy the add-on, all right? But that's it. All right, so we talked about adding items, we looked at service items, and I have an explanation on each of these. Non-inventory parts, sales tax items. Of course, we talked about closing the accounting period the other day. So now let's go on to actual transaction entry. I like to look at it from a cycle approach, meaning here's the sales cycle, here's the purchasing cycle, and then we wrap it all up in the end. In reality, you may have an employee cycle, but we'll cover that. So for many of you, how many of you actually invoice your clients? Okay, so we'll talk about invoicing clients, and then we're going to talk for the people who just get the money, all right? They don't need to create an invoice because they're causing themselves extra work. So when you're creating an invoice, and I'm going to be focusing on this section of the home screen. Remember yesterday I told you there's a flow chart that shows you to receive a payment, you must create an invoice. So if I go in here and I create an invoice, I pick the customer, and let's see, I try to follow what's in here. Did I even put one in here? Nope. So let's just pick Adam's Candy Shop. Now, where did it get all this information? When you created the customer account. Remember yesterday we talked about creating the customer? So that is the default. That does not mean you can't change it on here. Because if you do change any of this information that was carried over on here, when you go to save the transaction, it'll say, do you want me to save it back to the customer? And you say yes or no. Maybe you don't. It's a one-time thing. All right, so always be careful that you put the correct invoice date in. And the reason for that is this is aging from that date. So, if a client is 90 days past due, it's using that date to determine it. So you want to be careful on that. The invoice numbers will automatically increment, so you don't need to generally fool with that. Yes?
Okay, question. So I've implemented an online scheduling system that creates your invoices automatically.
Uh-huh.
So if a person schedules a session on November 4th, that date, right now it says November 4th.
That's what it should be.
Mm-hmm.
That's the date. All right, so then again, these systems will tie in. I know I have one client who ties into like UPS and brings in those charges. So you can do that if you're shipping a lot of stuff. These are called the line items. And again, see the item code right there? So I could send 10 of, I don't know, let's do an inventory part, a 1/2-inch irrigation line. The description it got from that inventory part, this is an inventory part. The price it got from the inventory part. The tax it got from the inventory part. This is a taxable item, remember. Uh-huh. Yes, it was when I showed you that item list. All right, so these inventory parts are already over there, and this is being pulled over from that card. So then again, you could pick the next item. Let's say we want it to be a service. 1 unit of, notice it tells you what the item type is, of installation. And they say it's $35 is what they have set back on the card. All right? And notice that is a non-taxable transaction. So look over on, first of all, look at page 50, and it shows you how you can drag and resize. And the nice thing with the older or the newer editions of QuickBooks, you can actually see what's going on in this customer over here. If you want to see that, if you don't, you just shrink that. But it'll show you the last time they paid. You know, you can go back and look at those things. But here's what I want to explain. Look at all these tax fields on here. So it gets confusing. Hopefully I can resize this so I can see them all. Notice that there's tax here, there's tax here, and there's tax there. You see those? All right, so how do those things interplay with each other? First, number one, this says if the customer's taxable, this line item, you charge a sales tax. This line item, you don't. Well, is the customer taxable? We look down here. And that's set as the default on the customer's account. So if you went and somebody gave you a resale certificate or they gave you a tax exemption certificate, and you would say no tax on that customer. Or if it's a church or it's a government entity, you would set the default on their customer card as no tax. Then it doesn't matter what this line item says. No tax is going to be computed. Here, this customer is taxable. This item is taxable. And it calculated on using this tax. So it would be Medina County, Summit County. You may have to change those on the invoice. Or if you're always going to that customer, you would set the default sales tax rate for the customer in the customer card. And then it would always come up, whatever county you're supposed to charge. And then this is the rate that's back on that sales tax item for that sales tax item. All right, so you see how all those different taxes interplay. If I said this customer was non-taxable, all of a sudden, even though I have a taxable item here, there is no sales tax charged.
The company we work for 1099 jobs, and they're in Stark County. But then we perform work all over Ohio, so sales tax we would charge on our supplies
you do the work. So you may have a customer that you have to charge sales tax on materials, and you go there to them and typically install it and all that, so you charge that sales tax rate. But let's say that then they call up and they just want to buy over your internet or something from your physical location, and you never go there, you're just shipping it, that's going to be from where you are. So it's generally from where you are. People are coming to you, or you're selling over the internet, but when you physically go there, it's where they are. Now, how would you like to be somebody who cleans houses? Right? Most people, you know, when they're cleaning houses, they're just doing it maybe part-time, they just want to make some money. These people got to charge sales tax. Isn't that crazy? I mean, how much burden can you put on somebody just trying to make some extra money? But they have to. And technically, you're supposed to file a city income tax return for everywhere you work, in every city. I know she's laughing, but it's the way it is. All right, so that covers what's on page 51. So, you know, you can have service items. Here we have just a service item. And then we also have the merchandise. The one thing I want to call to your attention is there are default templates. Because whatever you see on here is what's going to print on the invoice for the customer. So you can't customize them. So if you're selling products, even though it's products with service, you'd want to use the Intuit product invoice. But let's say you're just doing services. You don't want to have something that says price each. You know what I'm saying? You're not doing those kind of things. You're just doing service. So if you went to Intuit service invoice, notice how it changes. The column names now become rate, because that's more in line with what you're doing if you're doing a service. Mm-hmm.
So what if I'm selling like cards? It says it's $12,000, but I'm going to charge you $12,000 for it, but at first I'm going to charge $11,000 for it. How do you invoice for different pricing?
Just type it in.
Just type it in. Okay.
You can override anything on here.
Okay.
I could say, you know what? I really want to make the rate on this $50 because you're a pain.
So you can invoice as whatever, you can still change it on the and it doesn't change the invoice item cost or rate cost.
Yeah. So, you know, when I go to save this, it's going to say, hey, you changed the rate. Do you want to change it back on there? And you can say yes or no. All right. What you put on the item is what you want to be your default. But what's on here can always be changed for that particular customer. You know, you'll have people, I've had people say, okay, you can say it's a half-inch irrigation line, but I have to also have this added on it. So you can type that in there. All right, so if I take this invoice, Adam's Candy Shop, I'm going to save and close. Say you've changed Adam's sales tax code. No, I'm not going to change it back there. Adam has some credits, obviously. No, we're not going to apply it to the invoice. Maybe Adam overpaid or returned some things. So now that's recorded. Once an invoice is in the system, you get it relieved by receiving the payment against the invoice. You have to do that. I'll have people who go in and they just go over and make a deposit. And then you go look and you go, oh my God, this guy's got like invoices 3 years old because you didn't take the payment and put it against the invoice. So again, pay attention to the flow chart. So I'm going to receive payments now. Well, this one's a sales receipt. I don't want to go out of order. Let's go to page 53 first. This is if you're doing an invoice. See this one up above the line? Notice it's above the line. It's after you receive the payment. It's up here. That's because this is the combination of an invoice and a payment simultaneously. Storefront sales. You come in, you buy it right there at the counter. I'm not going to create an invoice and bill you and then get a payment. Instead, I'll give you a sales receipt, just like at the cash register. QuickBooks does sell a point of sale add-on. So here, what you're doing is you are, let's do this guy. Notice you can do cash, check, debit, because you are selling the item and getting paid for it at the same time. That's what a sales receipt is for. Right? Mm-hmm.
I'm not sure when to ask this question.
No, go ahead.
It fits in on here, but how do you, if you get a deposit, what kind of item is it? I get a deposit against, do you put that as a separate item?
If you get a deposit, it's going to go in and it won't be recorded against the invoice. You would record that. And then that person's going to have a credit balance sitting on their account. So then when you go to do the invoice, remember how it just said there was a credit? You would apply it at that time.
Okay, and if a customer places an order and you create an invoice, and maybe they do a deposit or whatever, if the order gets canceled and they decide they don't want it.
We're going to talk about that, issuing refunds and credit memos. Yes?
This might be backtracking, but, so I have a commercial fee. So if my invoices, like for each customer, it's a certain price every single month. Is that, like, can I do that in the invoice as just, it's always on and out?
We can actually, we're going to see here in a little bit, we can memorize transactions. It makes life so much easier. So, you know, if you have bills that are the same every month, or you have invoices, like you want to invoice people for rent in your buildings, memorize it. And then we'll see here in a little bit, QuickBooks will automatically record those entries for you. And then all you got to do is print them, which makes it nice. All right, so that is the difference between create invoices and create sales receipts. And to try to help you remember it is to always look at the flow chart. The flow chart's critical to me. I always have to visualize something and try to understand how it works. So here it says, go here, then go here. Well, here it says, hey, you already bypassed those two. Because I'm not going to wait for my payment. I'm getting my payment at the same time. That's the difference. All right? But again, everything else is kind of the same. The form looks the same. We're still selling an inventory item. Yeah.
Sorry, one other thing. Remember we were talking yesterday about getting payments through QuickBooks or through Square or whatever. Just a comment that everybody's taking payments through QuickBooks. It's really nice because it records the payment.
It does.
Against the invoice.
It does.
So you don't have to go back.
Yes. If you use their service, it will do that. All right, so let's say now we're memorizing a sale. Do you see on page 54? That's what I was talking about. So for your commercial cleaning business, if it's the same amount every month and you just want to send the bill out to the client, you could go in here and you can create an invoice, pick that customer, and then pick the item, and whatever the rate is, $100. Once you have that, you then go to edit, memorize the invoice, and I give you these instructions right there on page 54. You memorize the invoice, and you can say, add it to my reminders list, or just automatically do it. And how often do I want to do it? So I want to do it monthly or weekly. Automate the transaction entry. How many, say it's only for a year, then you have 12. 12 times this is going to happen. Actually, I picked weekly, so it would be more than that. All right? And then you're done. And then when you open up your QuickBooks on that day that this thing comes due, you'll see a little pop-up list that says, record this, enter these transactions, boom, boom, boom. I do that. I know every month my internet bill is going to be this, and every month my rent's going to be this. So why do I want to enter that every month? You just go ahead and automate it and let it go through and do it. Yes? You would use that for the 12 installments, yes, if you're invoicing them.
Now, at any point, you go in and change that?
Yes, absolutely. So let's say, I'm going to save and close it. When I go to list, it is a list, memorize transaction list. There's all your memorized transactions. If you don't want them anymore, you go here and you say delete. If you want to change the date, that actually opens the transaction. So you could actually change the amount and resave it over top of this if it changes. But if you want to edit the actual transaction, all right, this one happens to be one that says just add to a group. So let me find one. So I just did Ecker Design. Edit, so you could change, now it's not weekly, it's monthly, or it's only got 2 more left. So you do that right from the edit memorized transaction list.
Probably you would use with the software, but like say you had a customer who would pay for Quickbooks or whatever for a year, and the first 3 months is a rate or one rate, and then the rest of the time it's a higher rate. Can you program that over, or do you have
You would do it with the memorized transaction. So you would make the first one run for 3 months and stop, and then you'd go back in and rechange it to a new amount and start it again for the next 9 months. Of course, it's not going to do it automatically. You got to have human intervention. Yes?
How do you record, like I send an invoice to a distributor, they always short pay it, they pay less than they invoice them. So where is that, how do I account for that? Is that?
We're going to see that here in a second.
Okay.
Yep, isn't that nice? You could just accumulate it and eventually send them a statement. All right. Somehow, where was the receiving the payment? Did I leave it out? All right, recording a credit memo or writing off a customer balance. That is on page 55. So when you're on the home page here, notice refunds and credits. No such thing up in the bills area, just down here. All right, we'll see where it is under the bills area. If you want a refund and credit, and it hangs out there all by itself, that's what we're seeing here. So you click the refunds and credit icon, you choose the customer. So I go back to Adam's Candies, and then I go down below and I pick whatever item they're returning. I don't remember what the guy had, a half inch, and they're returning one of them. Now here's what you need to realize that happens. This is an inventory part. It's only an issue when it's an inventory part. Because remember, quantities are counted. QuickBooks is now going to add, when you post this, it's going to add that quantity back into inventory. What if it didn't come back? What if you just say, you know what, I'll give you credit for that? Or it came back because it was broken. Well, you can't override what this is going to do. This is going to take whatever you're crediting now for on the quantity side and add it back to inventory. And we'll see here in a little bit how we then have to take the next step and adjust the inventory to write that item off. All right, so always think about when I do a credit memo, what's going on behind the keys? It's actually removing the cost out of your cost of goods sold, putting it back into your asset, your inventory asset, and adding the quantity onto your item list. Now that's fine if they return the water, I'm going to resell it. But if I'm not, I have to then go adjust the item. Follow? So it says, if it's a return of items, fill in the line item area using the information for the item on the original invoice. That's what it says on page 55. If it is a write-off, a bad debt, it is a write-off, although we don't recognize a bad debt on our tax return, because remember, we're a cash basis taxpayer and we never recognize the revenue. But you are writing it off. Then you should use an item, I call one called uncollectible account. I create an item called uncollectible account. And then I said, see later in illustration on creating this item. And I give you that on page 57. That way you can then go run a report on uncollectibles and see who's underneath there, right? And what is it doing? When I set up the uncollectible, I name it uncollectible accounts. I then expense it to uncollectible accounts. I create a line item called uncollectible accounts. And it's an expense. All right? So it'll go, because remember, a credit's going to negative it. It's going to take it off. So it'll be a reduction in your sales. Question? No?
So just to be clear, so you use the uncollectible line item if you don't plan on selling that line.
If I'm not going to be able to collect this guy's invoice.
Oh, got it.
Somebody who I've tried to collect, I need to get the invoice off the system.
Got it.
They don't owe me enough to go sue them,
Right.
right? I just say, chalk it up, move on.
And then it's just put on.
And then it gets expensed off your system. It comes off your accounts receivable list.
Well, I guess my question is, this often happens in my business where we'll get returns. Some products are won't be selling, make them credit them, just say we do. But then, how am I, one thing that we've got a hard time saying is, how do I ensure that all that quantity that's coming back is not all going to do?
That's what we're going to see. We're going to see here later on, we have to do an inventory adjustment.
Oh, okay, got it.
All right? That's what I was talking about.
Okay.
So, yeah, because when you record the credit, whatever quantity you put there goes back in the inventory, as well as the cost, but that may not always be the case. So then when you go and you put this credit, and I go to save it, it'll say, what do I want to do with the credit? Well, since this person never paid the invoice yet, I'll just apply it to the invoice and it'll reduce it. If they've already paid it, maybe I just retain it as a credit for future invoices. And you saw on that one time when I was creating an invoice, it says this customer has credits, do you want to apply it to it? Or you actually give them a refund because that's the only time you'll ever deal with them. All right? So it'll prompt you for that. If I say apply it to an invoice and say okay, it's going to bring up whatever invoices are there, and you want to mark it against the invoice that you actually gave the credit against. If that applies, maybe it doesn't. Maybe it's just a credit you gave them because you shipped something late. They didn't really return anything. So, hey, I'll give you a credit, make you happy. And then you just apply it to whatever invoice is still there. Any questions? All right, so then I get to recording a customer payment. Genius me, by the way, it's better. And that's where you simply go in. And this is going to answer your question when you get short paid. All right, I don't know if this person obviously doesn't have any invoices. Let me find somebody who has an invoice. All right, some people have invoices. It shows up down here, all right? Let me find one that has, see if I can find one that has a lot. If there's multiple invoices, remember yesterday I talked about using auto apply. If you have that set up in the preferences, then whatever you key in here is going to go to the oldest invoices. That's not always the case. You ever have clients send in an invoice and they write in there what they want paid? Well, you gotta make sure you apply it to that invoice. If you click this and you have said, I'd like you to automatically calculate, and look, when I pick that, it did $35. But let's say the person, you know, paid you $29.99. They like the penny. You know, I can't type. All right, $29.99. Now you got a penny left, right? Notice down here what it says. Leave this as an underpayment or write it off. You want to write it off at that point. So it'll make that go away. Who was the one that asked me the question on that? Somebody asked me? Is she awake back there? So this is where, when you're recording the payment, you just change the amount that they're paying, and then down here you would say, leave it, you know, write it off. It'll write it off right then. It'll say, where do you want to write it off to? And you could write it off to that uncollectible account, sales discount, whatever.
Would that be the way, like I described last night, like I did 1%, they paid within 10 days? Am I handling it this way?
No. No, that's a good question. Here, you would go into discounts and credits and give them, all right? And then where do you want to track that? You pick the account that you want to track that in. Maybe you have a discount account.
Wait, the account? Or the
General ledger account. These are always the general. Everything has to have a general ledger account. Here, that's already set. They put it as design services. I have no clue. So let's say you put it to uncollectible account, or you actually want to track in a general ledger account how much sales discounts you're giving. That's an income account, and it's called sales discount.
And it'll automatically reduce the income that you realize.
Yes.
Which you said before.
Yes.
We're on
You're on cash, so it'll reduce it, yeah. And it will clear out the person's invoice.
The new version of Quickbooks coming out, when you receive a credit card payment, it's automatically pops up to get that.
Oh, that would be awesome. You mean in the 18 version? I have the 18 version, I just got it, so that would be nice.
And it'll pop up.
Because that's where you put that credit card thing. You could put that in there.
Well,
With
it's
some.
sometimes you don't know until you look at your bank record.
Yeah, with Square you do, but you don't. Yeah. And what I hate with Square is, let's say you ran like 10 transactions that day. Every time you got to figure out, okay, last time it was this much, this time it's this much, now it's this much. That's why sometimes maybe it's just easier to just do a journal entry for the whole discount. All right? Or negate it in your deposits when you go to make your deposits. Any questions on that? Yes.
What if they're not paying you exact quantities of product that was shipped? So it's an underpayment, but it's actually quantity. So it's like a return, but you're not actually getting product back.
You do the credit memo first and then apply the payment.
Okay.
It's a two-step process.
And then you go back at some point
And then we'll go to inventory and you'll adjust it. So you have 3 steps, really. The first step is the credit that reduces the invoice for the quantities. Or, you know, and that's if you really want to track how many of these things are getting returned. I mean, is it being returned because there's a problem with it?
it's food, so they're saying it's out of date, but
Okay.
it's not.
Yeah.
But there's nothing I can do about it.
You know, and if you don't want to be that specific, then when you do the credit, just don't have have like a service item or a other charge item, and that way you're not adding quantities back. Then you don't have to do that last step of the inventory. Are you following what I'm saying?
Mm-hmm.
You only have to do that when you're crediting an inventory part. So if you use some other type of item, non-inventory part or a service or other charge, then, you know, maybe you set up another charge that's called return food. I really don't want to track the quantities because it didn't come back. then you don't have to do that last step that goes in and adjusts the inventory. So it just depends on what kind of record keeping, you know, if you ever want to go back and analyze who's returning what and what are they always returning. And then the next time they buy, say, dude, I'm not going to sell this to you anymore because you keep returning it. Just kidding. But if the person is actually paying you short on an invoice, just record that and write that off. You know, I always have this one client, no matter what you do, you'll send him an invoice, and maybe there was postage, so it was like $150.49. Well, he just sends $151. I'm like, no, you just overpaid me. Now I have to figure out how do I account. Okay, so I'm a little OCD, sorry. But remember, I'm not really using QuickBooks. I use a proprietary product to do my invoicing because QuickBooks can't do what I need to do on the sales side. All right, any questions on that before we go on? Yes?
On the initial invoice, if it's not something that, it's dependent on something else, like them paying you within 10 days, but you simply go, okay, you're buying 3 different types of services or items, and you automatically want to go, okay, discount, 4% or whatever. Can you put that on the line and simply have it calculate a 4% discount off the price?
No, what you would do is, remember I told you could have price levels? Well, what you could do is when you invoice it, just reduce your rate 4%. You understand? So if it came at $50, you reduce it by 4% and charge less than $50.
Yeah, I was just thinking,
that'd be the
so
easiest.
The customer would realize, oh.
Well, you could also put down in the memo hour, we gave you a customer discount of 4%. All right? All right, so let's look now at page 59, because here's what you really have to understand. You're not just blindly recording things. There's stuff going on behind here. And what's going on is affecting your financial records. So you need to understand what each one of these transactions does when you save it. Notice what it says a sales invoice will do. It will increase the balance in your accounts receivable, which is an asset, and the balance in your sales income account. If you're selling inventory parts on there, it will record the cost of goods sold. In addition, it will increase your cost of goods sold and decrease your asset called inventory. So that's going on when you click Save. All right, that's what happened behind the keys. So sales receipts, and notice the difference between sales invoice and sales receipt. The difference is you don't interact with accounts receivable. You're interacting with your checking. Because I sold it and got paid simultaneously. I don't have a two-step process where it's an accounts receivable that I later collect. I collected it at the time of sale. So I said, note, regardless of whether it's a sales invoice or a sales receipt, and when you are dealing with inventory items, item parts, then you decrease your inventory and you increase your cost of goods sold. That's the matching concept of accounting. I match my cost with my revenue. The cost was buying the water. The revenue came when I sold the water for the additional price. A credit memo will reduce the balance in your sales income account, and it will reduce the balance in your accounts receivable. So you should be able to see these things, guys. If you're not real sure that you did something right, go find a transaction in the and we're going to see how to drill down and see what happens in an account. We'll go drill down into that on using reports and see if that's really what happened. That's a good bet you did it right. Customer payments, it explains what that's going to do behind the keys. Notice I told you at the end of every cycle I'm going to tell you how to fix things. Page 60 and 61 explain how you fix sales cycle transactions. Sales cycle transactions deal with all your interactions with customers. So when you look at your accounts receivable register, so I want to go see what's in here in AR. I'm not going to say this. See accounts receivable over here. This is my register here. I can open up one of these transactions and see what occurred. But when I want to correct it, I go to the Customer Center. Remember, I said that's the place where you go to find things. So I'll go Customer Center. And I'm going to look over here at the transactions. If it is an invoice that has been paid, you got to get rid of the payment first to correct the invoice. And then you'd have to go re-record the payment. You want to say, what was the last step I did, and unwind it that way. I show you that when you're using this, remember we talked about this yesterday, those filters, if you look at page 61, on the right-hand side will narrow to what type of transaction you're looking for. If you know the customer. If you don't know the customer, you want to look for just a particular transaction, then we go to this other tab here, Transactions. So you go and find the transaction, and then you can fix it. So if it's an invoice, like I said, this one was paid, it'll tell you. Or it'll say it's partial pay. You can't be changing this invoice till you void the payment, fix the invoice, then repost the payment. Never try to correct a customer transaction without doing it through the window you recorded it in. Because what will happen is you will throw your accounts receivable out of balance with your balance sheet. It won't balance. So when we look at reports on page 62, there are sales cycle reports. So if I go to reports and I go to sales, I can get sales by customer summary, sales by detail. So you can analyze who's buying the most product from you. If you have salespeople and you create representatives for each customer, you can track how much they're selling if you give them a commission. Sales by what item? What items do I sell the most on? And again, when you open up a report, you can always go in and try to customize it. And perhaps you add some other fields. See all the little fields, the columns you can add there? You just check them and uncheck them. Let's look at customer receivable reports. At least once a month, if you're invoicing, you should run a report called Accounts Receivable. Maybe you do the aging detail. These are all the people that owe me. This person has a credit memo. That credit memo for $1.60, somebody should apply it. You should go ahead and apply that to that invoice. All right, so they match up. You should be looking at these things. Notice that this says on December 15 of 2020, your accounts receivable is $35,919. That number should agree to what's on your balance sheet. So if I go to reports, company and financials, and I run a balance sheet, on the same day, make sure you run it on the same day, the number is the same. How does it get out of balance? People make journal entries. If they think they're fixing accounts receivable with a journal entry. Doesn't work. Or they change an invoice, but don't remove the payment first. So now it's out of whack. Because what happens, it's really strange in QuickBooks. Even though maybe the invoice amount didn't change and the payment didn't change, but unless you go back into the payment, uncheck it, and recheck it again, it doesn't apply it right. It's weird. So it would be hanging out there and not be matched. So you always want to unwind the transaction to the point where you need to get to the transaction you need to fix, and then put your stuff back in. Do you understand? Now, remember the other day I told you the IRS will ask often for your books. They want this. And, depending on who the auditor is, they may sit back and say, well, you don't use QuickBooks. Well, that's already a negative. You're not a very good business person. And you don't have your bank statements. Oh, that's already another negative. Because what kind of business person are you? It says you as a business person have a duty to keep your records. So they'll come and they'll want your QuickBooks. Whatever you do, don't go in there and start changing a bunch of things. Because there's a thing in here called an audit trail. It knows what you did and when you did it. So you go to reports, and you go to accountant and track. You see that audit trail? They look at that. And I said, I called you for audit, and then you went in and made a bunch of changes. You don't do that, right? The days of panic mode, fix matter can happen in the past. So that's the one thing you want to do. You don't want to do. The other thing I always recommend is make a backup. When you're done with your tax return for the year, make a backup of this data file. Because when the IRS comes in and says, I'm auditing, what are we in, 17? They come and say, I'm auditing 2015. You don't want to give them 16 and 17. They didn't ask for that, right? They asked for 15. So that way you have a backup of your data file for 15 and say, here you go. There it is, and they restore it. There is such a thing as a statute of limitations on going backwards, so you don't have to worry so much about that. It's 3 years from when you file the return, or if they find fraud, it's 6. So it's more the going forward. And generally they never open up an audit going forward if they don't find a problem in the year they're auditing. Yes. You mean a financial audit? Okay. Yeah, but it's a little bit different. You have to realize when a CPA is doing a financial audit, they're just looking for reasonableness. The IRS is drilling down to minutia, and what they're really focusing on are certain areas. Every time you're audited, I can guarantee you what they will request from you, and they will always request your bank statements, so they add up, make sure your deposits are there. They will ask for any travel log, and if you don't have it, you get 0 travel miles, 0. They will ask for your meals and entertainment, and they want to know the business purpose that was written on each time you charged a meal. And if you don't have it, give you 0. Because that's called the low-hanging fruit. They know people don't do it, and so they know that they can get it thrown out, and you've lost the expense, and now you owe extra tax. So you want to make sure those are the areas you document. And that's a little bit different than a financial audit. A financial audit is not geared towards that. They're geared towards within an error of, let's say, I don't know, I would say to you maybe if there's a difference of $5,000, it's immaterial. Well, the IRS, that's material. That's dollars in tax. So it's totally different. Yes?
What actually is on that audit trail report that you have?
Every transaction you did.
Oh,
When you fix something, When you book something, every invoice, it knows everything you did and who did it, and when you did it. Used to, QuickBooks never kept that, all right? That was one of the complaints accountants had, is there was no way to know what people did in the software, but then they added this, and now, since that's been added, the IRS wants
I have
these.
a problem with the word audit trail. It's really a transactional record of everything.
It is, but that's what they call it.
Audit trail makes it sound like, you know, somebody's checking up on somebody, and it's just really.
We can use it to check up on people.
Yeah, right, okay.
Yeah, but that's what it's called. It's the Audit Trail Report. Yes.
Is there a place for log travel anywhere in QuickBooks?
You would just record your travel expense. What I recommend people do is you keep a calendar, and what it needs to say is your business purpose. I don't go to the point where I write down, my mileage today was 157,000.15 on my car. And then when it was done, it was, I don't do that. But you need to say your miles that you have. So let's say I went to your place of business. I'd write that, the date, and the mile, the round trip. And then what you're doing is recording the expense as, you know, if you write yourself a check for that, or you just make a journal entry as a member contribution. The key is that you have the log, so that when you get audited, you hand over the log to the IRS, because that's what they want. I had a gentleman who was a repo agent. He went around and repoed commercial property. Now, you know, he traveled everywhere. He got audited. Of course, his records got destroyed. And his accountant died. All right? I said, like, dude, I don't know if I want to touch you. And so I said, I don't care what you do. You go back to wherever you did work in that year and you create this thing. Because if you don't, you will get nothing. That is the one section of the tax code that says you get zero deduction without a travel log. You get zero deduction if you don't explain any type of travel. Hotel, airfare. Why are you doing this? What's your business purpose? Yes.
I thought someone told me once that, like, toll roads and parking, that there's a certain threshold where even if you lose the receipt.
They don't look so much for the toll roads. They look more for mileage. All right, you have a guy come in and say, I have 27,000 miles. I say, that is not possible. There's no way I'm going to let you claim 27,000 miles this year on your car. What are you doing? That is a red flag. Unless you can say here, yeah, I'm on the road every day and I travel clear across the country, come back. That, you're asking for an audit when you do those kinds of things. And I've seen people come into me and they have problems, and I'll say, you know, this guy, his wife did his return. I said, let me make your first suggestion. Your wife needs to stop doing your return. Because she took $5,500 in non-cash charitable contributions. Red flag. So the IRS sends a letter and says, we need to see proof that you did this. Usually something like that, you have to have some kind of valuation. That's a lot of money for giving away your junk. Right? Go ahead.
I don't know if this will help anybody else, but I use an app called MileIQ for mileage that is on my phone and it automatically tracks.
Yes, it does.
And you swipe to say whether it's business or personal. And it's nice because it shows you where on that you went, where to you went, and then you can put in like the reason, the business purpose and all that, and then it all uploads automatically. It's a beautiful thing. What's the name?
MileIQ.
Called MileIQ.
And then, you know, when they want to know where you are in life, just kidding. I saw the new Amazon thing that said something about, here's a security cam for your home that's in the cloud. I'm like, are you kidding me? That's like Big Brother watching me. There's no way I'm doing that. Especially on Amazon or Google. Sorry. Yes.
That's on your sales receipt. What would you do with an item that's a pre-item item, incentive, purchase something right now?
You wouldn't be a sales receipt. You would then go in, what we would do is we could just do a straight inventory adjustment. and write that off. I see what you're saying, it's like an incentive.
Right, but if they purchase something else, but if they don't basically add another purchase the other thing.
Oh, I see what you're saying. But your purpose for putting it on there is that you want to get it out of your inventory?
No, it just is an incentive to buy other products.
Right, but what I'm saying is, are you actually putting it on the invoice and sending it to them? Because what you would do is, you would put one quantity, the cost would be, the sales price would be 0. All right? But if you're not wanting to list it, then you just do an inventory adjustment. Any question? All right, so let's go on. When we look at page 65, I just showed you a little bit ago how you can customize your reports. All right, you click that customize. Now every report is going to be different. So not every report has the same ability to add additional columns on it. See here, we don't have a lot of choices with the accounts receivable report. Whereas on another report, we may be able to enter all different kinds of columns of data. The other thing is, you can then filter. If you look at page 66, you can filter to show only certain data on the report. So a filter says, yes, I want this report, but I don't need to see everything. I just want to see certain customers. So we can go over here, scroll down. Right now, the filter is today. So we can scroll down and say, I only want to see, click name, that's customer name. I only want to see, I'll do multiple. These people, these people, these people, these people. Hopefully these people have balances. And those are the only people that will show up on the report. That's what a filter does. It further drills down to say, you know, just give me this much information. Now, when I'm on here, I can actually go open up the transaction. I'm on the audit report, sorry guys. But I can open up that transaction. That's called drilling down in a report. You double click and drill down to the detail beneath it and find the transaction. And if you say, oh, I screwed that up, I need to fix it. This is a credit memo. If it hasn't been applied, which I don't think this one has, because it would say it, all right, then you can adjust it here and resave it. Page 67 talks about printing, emailing. Yes, go ahead.
I'm sorry, there's an indication includes split detail.
Split detail means it hit multiple accounts. So it can't list all the accounts. It's just saying, where are you seeing that at? Right here. See, this says it hits accounts receivable. This hit accounts receivable, that hit accounts receivable, this hit multiple. It hit other accounts. Yeah. So again, on all of these reports, you can print them, you can email them, you can also export them to Excel or a PDF. Mm-hmm.
So you were talking about record keeping and stuff. So if I am interpreting this correctly, at the end of the month, you can run a balance sheet and a profit and loss statement, save that, and then email it to yourself so you always have that, and you don't have to keep hard.
Well, you don't have to email it to yourself. You can just save it to your computer. Well, you don't really need to do that because you can always go back in here and rerun this report.
Oh, okay.
All right? But let's say I said, hey, can you send me your P&L? You could then PDF it, send it as an email, as a PDF. You could export it to Excel. Now what I do, on my perspective, a client will send me their Quickbooks file, because there's a feature here that says file, send company file, send it to the accountant. So what that does is it says it allows you to keep working in QuickBooks while you send it off to your accountant to review past transactions.
So is that accounting copy as a default in the system? or you created that?
No, you would, no, that's here. It's always on the file menu. You would go and say, send it to the accountant.
Well,
All
I
right.
guess I was equating accounting copy, like in the tax return business, as you probably know, there's an accounting copy, there's a filing copy, and there's your own.
Oh, no, no, no. This is when you're sending your QuickBooks data to your accountant.
Right.
So your accountant's going to work on your tax return. So they need to see everything for last year. And what you do is you want to keep using your QuickBooks. So what QuickBooks does is it puts a lock on it, and it will allow you to go backwards, and it will allow the accountant to go forward. So you can keep using it. Now, when my clients send me that, I always export the profit and loss and the balance sheet, because I never know what those guys are going to do to it when they get it back. So like I said the other day, I would go and do their tax return, and I'll have this was your P&L, this was your balance sheet, and then I go to do it the next year, especially when you're a corporation or any type of entity, and it's got to roll forward. And I'll say, how did that stuff change? You guys changed it. So then I will save those copies. Every year I save it.
Along similar lines, a bookkeeper that you may list to help you along the way, is there a concurrent user license where you can access the account? I think you discussed
Multi-user. But then you'd have to have it sitting on a server. So you're getting a little more.
the cloud version, but does that have 2 licenses for the base package, you know, of the books?
I think you can be in it. You guys use the cloud. Can you be in it like 2 times? I think you can. Whereas if it's a desktop, you can't be in that data file simultaneously without a multi-user license, and then your data file's got to sit on a server, so you're both on the same data file. All right? Huh?
I missed part of the question.
Well, you'd have to be in with your same login, which is a concern.
No. Well, that's what I'm saying. Like, we can both get into my file, but we have different logins.
Yeah.
So we're looking at the same instance, but everything I do is tracked.
And you only pay, and they don't charge you for multiple user, do they? So there you go, for the cloud, they don't.
Well, but it might depend on which version you have. I don't have the simplest one, I have the next one up.
Oh, okay.
So that could be why I'm.
It could be. It might have to look at the pricing package. All right, so then there's such a thing as generating customer statements. A statement is different than an invoice, because what a statement's going to do is set forth all the unpaid invoices you already sent them. You have clients that haven't paid, you look at your accounts receivable list and you can see, well, you're a lot of money. I'm going to send out an accounts receivable statement that sets forth, all right, what they owe me. So that's how you run those on page 68. All right, so let's now look at, and none of you told me that my zipper was unzipped. You are in trouble. All right, so now let's go look at purchasing cycle. Pretty much a lot of the things we do here. Remember I told you the other night I talked about purchase orders and how they are a legal document under the Uniform Commercial Code? It is an offer and acceptance. It's a contract. To have a contract, you don't always have to have something in writing. Of course, I always recommend you do. But what you need to have is an offer and an acceptance, something that shows there's a meeting of the minds. So when you issue a purchase order to somebody that says, I want to buy 5 units of this water at this price, and you sign it, then you're telling that vendor, you fill it, and I have to pay. It's a signed offer, and they accept it by performing. And under the Uniform Commercial Code, if they perform, substantially perform, you owe them. So that's why purchase orders are important. From your perspective as a seller, you would also like to get a purchase order, right? Hey, you have a purchase order? Send me a purchase order. It should be signed. Always should be signed. In QuickBooks, when you create a purchase order, once you create it, you then receive the inventory against it. So I'm going to create a purchase order here to Gusman's Nursery. There we go. And the item is going to be plants and trees. Oh, a citrus tree. And I want 45 of them. No, I want 5 of them. All right, so notice the price here, that's the last price you paid to purchase it. Might not be the same price, but remember, you're sending this purchase order over to this vendor. They may come back and say, hey, I don't sell those for $46 anymore. They're now $50. So then they didn't accept your purchase order. And they may make you revise it. All right, so then you would then print this. So let's do a print, preview, and that's what it looks like. And you can actually email this to the vendor if you have their email. If they accept it and they fill it, then you're done. You pay them. So now what happens? What's my next step? I send a purchase order out, and all this is a database tracking thing. Nothing gets recorded at this point. Because all you did was send a request to buy these items. Save it. So now the items come. Your goal is to get those items into inventory as soon as possible so you can resell them. So that when you're creating an invoice, your system knows you have this quantity on hand. So if they're really efficient, they send you a bill with the product. If they're not really efficient, they send you what's called a packing slip. You've seen those, right? And the bill comes later. So when they send it without a bill, what you're doing here is you're going to record that packing slip because nothing gets put into inventory so that it can be resold until you either put a packing slip in here or a bill. So I would then pick my vendor, which was what, Gusman's? And notice it says, hey, there's an open purchase order here. Do you want to receive those items? Yes. And they have this one, and now I'll say that one came in. And I got all 13. Maybe you didn't. Maybe you only got 10 of them. All right, so you can change that. Oh, I'm sorry, maybe you got all 5 of them. I'm looking over here. Maybe you only got 4 of them. So it'll keep that purchase order open for that one. Now you can't pay this vendor yet. You can't pay Gusman's yet. Because they didn't send you a bill. Right? They just sent you a packing slip. Why would you pay them until they bill you? It's up to them to come collect their money. So let's say we do a new one, and let's say this time Gusman's did purchase order 11, and this time they sent them all to you. Well, I don't want a receipt. Let me close this out. This time, you received the inventory with a bill, all right, from Gusman's. Now, it's going to put those items into inventory, and it's also going to appear on your accounts payable. So you now can pay them because a bill came with it. Yes?
So, if anyone else has a similar situation, what happens if you purchase the product and it's direct ship?
That's a drop ship.
Drop ship. So you would do this upon, if I don't get a package, if I get an
Right.
order confirmation, but you would do.
I would do it on the order confirmation.
On order confirmation.
Yeah.
Use that as the package.
Yeah,
slip,
yeah.
And then the invoice comes.
And you'll notice that when I went and did the purchase order, there's an option there for it to be a drop ship. Meaning It goes right to the customers. Never comes to you. Yes?
So what if you get your package slip, but instead of billing you, they automatically take it out of whatever your credit card is? Is that what that would be?
Then you would record it with a bill.
Okay, so you're saying,
Or you can receive the item with the credit card too. All right? Remember, whenever you open up transaction windows, you're going to see two tabs. Usually on this purchasing cycle, you'll see the expense tab and you'll also see the item tab.
Question.
Yes?
In QuickBooks, if you were going to bill production, like bill materials, does it make sure that you have inventory of the items that go into making that product?
That's when you're talking, not at this level,
Okay.
but if you buy certain manufacturing add-ons, that's what we were talking about on the manufacturer. This is not intended to be for manufacturers.
Okay.
If you want to get that sophisticated.
So in that package, you'd have to have inventory.
You'd have to have, you have inventory, you just don't have the sophisticated inventory, the higher up, that does assemblies. You need something that does assemblies. They took it out of QuickBooks Pro. It used to do it in the old days. Now they don't. You have to buy the higher edition. QuickBooks Premier. They also try to sell you what's called a manufacturing add-on. They'll have, if you go out and look on the QuickBooks site, they have ones designed just for nonprofits, just for manufacturers, just for that. All right, so once we've recorded this, we've now, we recorded the inventory without getting a bill, and we recorded the receipt of inventory with the bill. Both those transactions posted the quantities to your inventory, so now you can go sell them. But only one of those allows you to actually pay the bill, because only one of them was a bill. So what happens when you receive inventory and the bill didn't come? You got the package slip. Well, later on the bill comes, enter bills against the inventory. Do you see the little flow chart? So we're only going to use this on that one entry. Remember Gusman's? That said we received the items, but we never got the bill. So now we're going to go post the bill against these items. Now let me ask you a question. Let's say when you ordered these things, all you did was order the quantities, and now there's some shipping charges on top of this. Anybody ever have that? Notice this tab that says expenses. That's where you put the shipping charges so that it increases the bill. So your items stay the same, but you're going to go over here and put shipping charges. Yes?
So that expense, can you detail the expense, like shipping and handling, and like, or is it just a generic expense?
You would come here and you'd
You can
say
list it.
shipping, I don't know if they have that in here, freight. I'm going to just pick an account. But normally it'd be shipping or freight. And then you could put something in the memo there that says shipping.
But that's not an automatic drop, and you have to populate that.
You have to populate it. All right?
Could you insert that inventory in your purchase order?
You could put it in your purchase order if you're aware of it. Yes. You could have an item that's called other charge, shipping, and then you'd put that over there. All right, so that's what we're covering on 73, 74, 75. And 76. So for those of you that deal with inventory, that may be the process you go through. For the rest of us in the world who do not deal with inventory, we are never going to use those little icons. Don't touch them. You may not even have them on your home page if you said, I don't do inventory. All right? What you're going to do is just go enter a bill. I dropped right there. But even better than that, for most of us, we don't even have to enter bills. Because most of us are paying electronically, or we're writing a check right there, a handwritten check. I do a few of them, not very often. You can just go down here and say, write a check. Skip all this stuff up there. You don't need it. It's all about what's the easiest way I can do something. You want to enter a bill when you're going to do a bunch of bills, and later on you're going to print checks. See that pay bills? So you bought these nice little computer checks, and you're going to go pay them. You're going to pay all your bills simultaneously. Now, there may be a point in time where you get large enough and you have so many bills. Anybody ever work in a big company where they have a lot of bills? And that's what they have to do. They enter all that stuff in. They don't write bills every day. And they'll enter all their bills in, and maybe they cut checks once a week. So then what they do is they will enter bills and then pay them weekly. But for most of us, we're not. Anybody in here doing that? You are? Okay. For most of us, we don't. We just, I don't know, I pay my bill. Most of my bills go on my credit card, I told you that. And then I just pay the credit card once a month. Why do I want to waste all my time writing bills? All right. Plus you get the points. But anyway, that's the only time you want to use that. So if you enter a bill and you're doing it the way she's doing it, and I pick my first, whatever I have in here, maybe it's my utilities, my cow oil, and I give it a reference number, which is usually the invoice number, but when it's a utility, you don't get an invoice number, so I might say October 17, 2017. And then I put the amount. Notice that it went down here, but there's no account assigned here because on the vendor, remember yesterday when I showed you the vendor, you pick that default account under the vendors, remember? So vendors, center. Remember I said the account settings? If you had set a default account here, it would already be down there. So you'd have to go pick up utilities and put that in there. If it is inventory, you pick an item. Remember, if it interfaces with inventory, you pick items. But for most of these types of things, they're just expenses. Rent expense, office, right, utilities. Then when you're done with all your bills, look at page 78. Maybe you get a credit. Remember for customers, there's a whole separate window where you enter a credit. Well, when you're dealing on the purchasing cycle, it's just an option. See that right there? Bill, credit. And believe me, the stupid thing saves it and memorizes it, so the next time you go in there, it did a credit. You're like, you just entered 5 transactions as credits, and it was supposed to be debits, because it saves it. Particularly when you're recording your credit card charges. Have you ever done that? And that thing stays on, and you're like, I just did 3 of these, and now I got to go back and fix them because they're supposed to be this, not that. But that's how you enter your credits to apply against bills. And that's what page 78 talks about. And then once you're done with all that, if you're going to cut checks, you use the pay bill window. And that's on page 79. And that's when you pick and choose what bills you're going to pay. If you're not going to pay the full amount, so let's say I pick Gusman's nursery. I'm only going to pay Gusman's $100. I change it right there. And it'll leave that $84 unpaid. And then you go put your check stock in the printer, and then you print them. And when you do that, it reduces your accounts payable and reduces your cash because you just wrote checks. But as I said, for most of us, we're not going to use this. We're never going to involve this until we get so big that, you know, we have people working for us doing this. Do you have a question? I see it.
So, yeah, I'm paying my bills now directly from my bank.
Electronic.
Electronic.
You're not gonna
Not
use this
printing
thing.
any checks like that. Are you saying I don't have to do this?
No.
Because bank statements is substantiated.
What you're gonna do, for those people, we only have one person in the room who's bulk printing checks. This is for bulk printing checks.
Right.
If you're not doing that,
Yeah.
then skip all this stuff. That just made you do like so much more work than you ever needed to do. What you want to do is go right to write checks. And then you would, usually they're EFT, you don't have check numbers, right? And you put the date, you pick up Cal Oil, I sent them $50. So what this does is this directly expenses the $50 and decreases your bank account. So I didn't have to go into a bill, and go pay the bill. It's two steps, I just did one. Now, if I have it on a credit card, I'm going to go down here, because this is write checks interacts with your bank account. See credit card charge? And remember the other day I told you, if you don't have a general ledger account of the type credit card, you won't see that icon. You don't flip out and go home and say, I don't see that icon. If you don't, then go on your chart accounts and make sure the account is of the type credit card. But what you're doing here is you're entering all your credit card charges. Then you're going to reconcile your credit card account. And when you're done reconciling, we'll see here in a minute, it'll say, do you want to pay your bill now? So you say, yeah, and then you put in the amount you're going to pay. I laughed because I had this client who sent me their Quickbooks, and they would just pay their credit card bill every month. So they would just record a check every month, $15,000, $25,000. I'm like, what is all this stuff in it? They have like $100,000 in miscellaneous expense. I said, I can never put that on the return. That's a red flag. What is this? Well, we just pay our credit card bill. I said, the problem is, you bought meals, you traveled. Meals are 50% of what? You traveled. You bought office supplies, you bought fixed assets. You've got to take all those things and put them in the right account. You just can't say, oh, I'm my bill, I'm just like you. Needless to say, she wasn't very happy. But she had to go back and reclassify them. That's why I just tell people, put your credit card charges in. Or if someone says if you're at a bank where they interface with QuickBooks, and some of them do, you can just download them into here. All right? And then sometimes it'll tell you where to classify those things. Any questions? Yes.
I apologize, I don't comprehend. When you enter the check manually and when the bank interfaces with this.
The bank only interfaces with it if you set it up. It has to be set up with your bank online to say, I'd like to download my bank transactions. And then you go download them.
And then you don't have to tell this that you were to check this online.
Nope.
Right? Yeah.
You may have to go in and classify what account that check goes to if you don't have your vendor set up correct to have a default account.
Now,
But it'll already be there.
When you're online checking, if you have the different categories that match up with the same categories on QuickBooks, it automatically knows.
No, they don't know online. When it comes into your system, it looks at that vendor and it looks to see your vendor, do you have a default account there? And it'll put it there. And if not, then there's a window where you change it before it records it. Yeah.
Even this, personal level, that application will take my bank statement and my credit card, and I have to loan and fill them all in, as long as I've done just what you said, initially.
Yeah.
I presume that this page version is all going to be the same.
Yeah, it's got to know where to look, and it looks to the vendor account to see what account you want to put it in. And then you have to approve all the transactions anyway. It doesn't just blindly book it. Because I could go to Office Max, and maybe this time I bought a computer, and that has to go over here and not be an office expense. By the way, you can expense anything that's $2,500 or less. Otherwise, it has to be capitalized, and your accountant has to then depreciate it.
So can I retroactively go in and do the writing the check to each? You say I've written about 30 checks, and then I have an initial balance, like put it in the bank July 31st, and then I get the 30 check. I can go back retroactively and put it in the amount I wrote to.
Yeah.
For that, have the items filled in.
Right.
The Audit Trail set up, she showed us we've done that.
Yeah, but that doesn't matter. What they look at is, you got an audit notice, and then you go and make all these changes afterwards. Oh yeah, don't do that. All right, so page 81 talks about using the write checks feature. Page 82 explains to you what happens behind the keys when you do each one of these types of transactions. Again, I'd like you to understand what goes on back there, so if you need to go find a transaction, you can understand where you should be looking for it. Then 83 talks about correcting. All right, so let's look now at page 86, setting up your tax rates and your agencies and paying your sales tax. So when we go to pay our sales tax, do you know that in Ohio, if you pay early, you get a discount? Does anybody know that? Yeah. So when you go to, on the home page, it says click Manage Sales Tax right there. And there are various reports you can run. But what I'm going to do is I'm going to say if you could do sales tax liability to do a preliminary report to look at it. But I'm going to say pay the sales tax. And I'm going to enter in showing my sales tax through, I don't think there's much in here. I'll take it into the future. And now I know my sales tax, all right? So you pick what you're going to pay. You see this adjust? That's where you record your discount. Remember, you're not really printing a check, right? Because everything has to be paid for your business gateway. So after you go on one and you pay, maybe you run this report, run that report so you can key it into the Ohio Business Gateway. How much were your sales? How much were exempt sales? And that's what you key in to the Ohio Business Gateway. And then at the end, when you go to pay, it'll tell you how much your discount is. Then you come back to QuickBooks, and you put that in as an adjust. So it gives you that sales discount. That's if you pay it early. Any question? Because I've had clients come and say, how do I put that in there? It says I paid this much in sales tax. Well, you're still paying all of this, but you want to go in and put in, here's my adjustment, because I got a discount. I usually put the amount because it'll tell you the amount. It'll tell you around the report what you got. Okay, so we have purchasing cycle reports. I'm not going to go through that. We have about 10 minutes left. Vendors, you guys can read this. Taking a physical inventory, page 91. Very, very, very important to do. People who go out and have an inventory. Particularly if you get bigger, right? Because just because QuickBooks says you have 10 items, maybe you only have 6. Ooh, what happened to the other 4? So you always want to, at least once a year, take a physical inventory. Print this physical inventory report. Now, if you're giving out this report to people to do it for you, you paid somebody to come in and do your inventory, don't give them don't give them the items that QuickBooks shows are in there, because I'll be just going, oh yeah, I don't want to count. I'm going to count 1,000 bolts. No, there's 1,000. Right? Don't give them the items that you think are in there, because QuickBooks thinks it's in there. Don't give them blank, and then they go count it. And then you go back and compare it to QuickBooks, and then you may need to do an adjustment. Remember we talked about on page 92 doing item adjustments. So when I look up here, and it says, go to, click the inventory activities icon right here. For those of you not using inventory, you won't have it. Choose adjust the quantity on hand. All right, so when you're here, you may adjust just the quantity, you may adjust just the value, or you do the quantity and the value. So when someone returns a product to you, remember, you said you don't always resell it. This is where you're going to go, and you're going to pick the item and say, hey, it says there's 1,864, but I really have 1,860. It'll make that adjustment down. So it's going to decrease the quantity by 4, and that's the value that will now be in your inventory account. And here is where you pick the account you want to book that to. So you may have like inventory write-off account. All right? But that's going to happen in your situation when you say that they return items, you give them a credit memo, it's going back into inventory, you want to get it out of there because it's not being resold.
So I just have to know how much, that inventory now.
Yes, yes. So mark that page 92. All right, our final thing is to look at reconciling. Please reconcile. I have clients come to me, I'll say, did you reconcile your bank statement? No. You're a cash basis taxpayer. You have to reconcile your bank statement. You have to reconcile your credit card. Now, as a cash basis taxpayer, you get to take, and the other reason you want to manually put in your credit card charges, is you get to take the expense as soon as you charge it. You don't have to pay the charge card. As soon as you charge it, you have a liability. Right? Like that. So you want to make sure, you know, most of our credit cards cut off in the middle of a month, right? Yes.
I have a question. On page 95, the transferring money between accounts.
Mm-hmm.
It's the online version, so we're going to put their bank account. So when we transfer money from one account to another, it counts as sales and unrecognized expense. What account should those actually hit? Because they're not sales, they're just transferring.
You should hit both bank accounts. The sales should go as a deposit in the bank account it got sent into, and the unrecognized expense should come out of the account it came out of.
So those are the correct accounts that they're in?
Yes.
But it isn't actually a sale?
I don't know why they named it that way.
Okay.
As long as it goes into the right account, you're okay.
Okay, yeah, it's going there, but I was
Yeah.
confused because I'm like, that's not the.
Yeah, that's kind of weird.
I just transferred it
I
from
know.
one account to another.
That's just whatever they're
Okay, so
calling
that
it.
is
Yeah,
correct.
you're okay.
Okay, thank you.
So this is an example of how you would just transfer funds between your bank accounts if you have multiple bank accounts. But reconciling your bank account is, like I said, the most important thing you do. Because it assures that you've picked up all your deposits and you've picked up all your checks. So when you go to reconcile, you pick the account that you're reconciling. And then I'm just going to put $1 in here right now because I don't know what's in there. If you have any service charges, you enter it there. If you have any interest income, you enter it there. You pick the account that you want that to post to. And then you click continue. Now often you're going to want to hide the transactions that are after the statement date because by the time you get around to it, you probably already put over the transaction. And then you just go down and click things that clear. And what I said the other day is, remember I told you I've gone into people's, I always check people's bank recs. I'll see a check, I was like, that is like over a year old. There is no way that's ever going to be cashed. Oh yeah, you know why? Because I just wrote them another check. Well then you didn't remove the old check, so now you got double expense in here. Do you see why it's important? Pay attention, what's the age of the transaction? You shouldn't have these real old transactions in there. Something happened. And then this is your checks and these are your deposits. When you're done in the end, this needs to say 0. If you look back, and you made a mistake when you entered the ending bank balance, then you can click this modify, and you can change it there. Same thing happens with a credit card. You have to reconcile it. How do you know all the transactions have been captured? By reconciling. Most important thing you do. Let's say you have a transaction and you don't know where to put it. I would say the most important thing is to capture the transaction. And there's an account that's always created in Quickbooks that says, ask my accountant. There's no account. So I tell my client, you don't know what it is, throw it in and ask my accountant because I'm going to look at that account. And then I will say, hey, you know what, in the future, these go here. But I'd rather you capture the transaction, reconcile your statements, keep moving forward so that you're always in balance. Like I said, when you reconcile your credit card, let me reconcile the credit card. But when you're done reconciling and you save it, and here's one here. They owe $24. I'll go back and make it 25. Then you reconcile, it'll say, write a check now, write it later. So I always say write a check now, even though maybe online I tell it to pay a week from now, because you always get them like a couple weeks in advance. And then you can print the reconciliation if you want. I'm going to say close. I don't care about printing it. Here comes the write check window. So I say EFT. Of course, you need to pick the vendor, Capital One, whoever it is. And if you're not paying the full amount on the bill, put in here what the amount is you're paying. Okay? You're not paying all the credit card. Any questions? Are you ready to close this one? That's why it says EFT. You still have to put it in here as if you're writing a check, but you're not writing a check. It's an electronic funds transfer. Okay. All right, guys, thank you.